going to a co-polarized world where we have big ones and niche ones.
Today, I have the pleasure to have in the studio Fèmy Mouftaou, who is Regional Head of Fund Strategy and Business Development for Benelux and Switzerland at IQEQ. Welcome.
Thank you.
It's a pleasure to have you back. You've been here several times, and I invited you to know exactly what fund managers need to do differently this year and going forward. So my first question to you is, what will IFMs actually have to change in their day-to-day operation under IFM2?
Oh, thank you for the question. Actually, before starting, we must take a step back and think a bit why FMD2, the second version, came. One of the reasons put ahead by the European Union was a bit more stability for this alternative market in Europe. Mm-hmm. So then more stability means as well a tighter credit governance for the loan origination funds and any funds doing loan origination, even if it's not their main strategy. So the first element, a tighter governance, but as well a more structured risk framework. It means that embed in their risk policies more details on the way they manage their risk when they issue loans, when they originate loans. And finally, this comes together with stronger and internal controls, because of course having higher governance levels means as well internal control to monitor and to control them.
Yeah, we had the feeling over the past years that this industry, the private credit, was growing like crazy, and now we're waking up with some stories in the news that some players might be a little bit in difficulty when all the investors are trying to get their money back. So can you just go a little bit more in detail about the credit risk policies and the details of AFM2?
Oh, it's difficult to come into details which is such a big text and a piece of regulation. What you must, again, coming back to the initial reason why the FMD was put in place, or the FMD was revised in a way, it's as well to put a bit more, institutionalize a bit more this market. And for example, it means watch a bit carefully the concentration limit, identify the borrowers, because you cannot borrow to any type of borrowers, and there are some rules that apply depending on the borrowers. More reporting obligations, this comes with broader data, we'll come back to that. And as well, for those loan origination vehicles that are not doing that as their main strategy, they have as well rules to comply with. Basically, FMD2 is putting a bit more, how could I say that? You know, loan origination at the beginning, the credit activity, it was a bit reserved for banks in the past. Now what we are doing for loan origination funds, it's putting a bit more rules bank-like. So typically, we want funds, loan origination funds, to comply a bit more rules that are a bit like banking rules, basically.
Yeah, just checking the score of the counterparts and everything. Very good. Where do you see the biggest need for support and guidance as fund managers implement IFM D2?
You know, a lot of people were saying, well, when you ask for a loan from a fund, it's faster than a bank. The loan origin funds are a bit more flexible in terms of granting the loan. Some people say in 2 weeks can be done, or less or more compared to banks. Then I think one of the challenges that will come is to embed in their risk credit committee, in the committees, the governance, the decision maker within the AFM, to put those rules and still keep the same flexibility and the same speed to market. That's probably one of the main challenges and the day-to-day operations. How can you remain as efficient as you used to be and comply with those new rules?
So it would be, for example, setting up a credit committee as banks do. We know that if you have somebody on the phone, they will tell you they're meeting next Thursday and this is the deadline. but while keeping the entrepreneurial spirit of alternative investment.
Correct.
So maybe meeting 5 times a week.
Yes. Well, they have already credit committees, of course, but the rules they need to check before putting a case to the credit committee will be a bit deeper and complex.
I'm sure then, of course, the digitization is coming into play. I'm sure data is getting at the center of everything now.
Yes, because one of the new rules will be to identify correctly, not identify, but there are some rules, diversification rules that will apply depending on the nature of the borrower. You need to know a bit deeper your borrower. And of course, you need to deeper your borrower, you need as well to receive data from this borrower. And then you need to have the control of the full chain of data of this market. And of course, this is not, it's an additional set of data to manage, to include in the decision process to grant a loan.
Yeah, I'm sure you need to be able to justify this trail of information whenever you are controlled by a regulator. It can be locally, it can be at European level. And maybe a last word about liquidity. We've seen in the media that people are getting scared now when they think about the liquidity of private assets.
Well, the liquidity, the main impact will be for open-ended funds. So you know that we have seen a trend of last years where not only funds, AIF, were granting loans, but as well they were granting loans. And because of the nature of the revenues of those loans, they were able to set up evergreen funds because of cash generated will help to manage the redemption flows. Of course, AFMD2 will put an additional set of rules to make sure that the liquidity management rules that are there in the AFM are there as well to protect the investors in case of a specific gating, of a lack of liquidity, of anyway, anything that could happen to the fund that may stress the fund in terms of risk. This being said, think about it. We are living in a stress environment nowadays. We have wars, we have tension on interest, we have a risk of inflation coming back. Having those set of new liquidity rules, new liquidity management rules is clearly a sign that we want as well to protect the users, the clients, and the borrowers of those loan originating funds.
Yeah, it sounds like illiquid funds are just catching up with liquid funds, and we had the UCITS fund from 1995 up to today, and they're hyper regulated, while illiquid funds like AFMD started around 2012 in Luxembourg with the toolbox, and we can see that regulation is catching up very fast right now. So if we fast forward 5 years, how do you see IFMD2 reshape the way fund managers operate?
There are rules in this second version of the IFMD2 that are not only for loan originating funds. You have as well rules on delegation, on oversight. This message actually is coming for one reason. The European Union has realized that after AFMD1, a lot of countries had put and set specific rules that were different from one country to another. So what I've seen looking forward is probably something a bit more coherent across the member state of the EU, clearly, with a bit more harmonization, if I could say, across the countries. So specific country cannot put specific rules without complying with the FMD2. That's the first element. And the second element, alternative being everything that is alternative, is probably a bit more governance and discipline across the management of those alternative assets.
Very good. Yeah, people are waking up, realizing that when we say alternatives, it can be a lot of things. It can be infrastructure, but it can also be debt. And I was talking with somebody from our institution in Luxembourg who told me that yes, assets are growing again recently, but then we should look a little bit in detail why they're growing again. And one of the main reasons is people are coming to Luxembourg to get some debt through those assets. Maybe one word to conclude about this? Maybe the main challenge?
I think the way I see the main challenge is that it appears obvious that not all managers, well, we are going towards a world where there will be only two types of global managers or fund managers. You will have the first big ones, the KKR, the Blackstone of this world, and the niche one. Having in the middle manager doing a bit of everything, doing credit at the side, or loan origination fund that is where it's not their main strategy. I think all these will be reserved to big ones or really niche players. We're going to a co-polarized world where we have big ones and niche ones. And AFMD do as well is putting some rules that will be difficult to comply, that those who are staying in the middle.
The same thing as you said, it's basically the barrier of entry is getting higher, more compliant and more expensive, and so we can expect, I would imagine, a concentration of the smaller players so that the market becomes more mature. Well, thank you very much, and we will track this in the coming months.
Okay, thank you.